The governments and companies don't always borrow money from banks. Sometimes they borrow money directly from people like you. And when they do that, they issue something called a bond. So what exactly is a bond? Let's break it down simply. A bond is basically a loan. But instead of you borrowing money, you are the one lending it. You lend money to a government or a company, and in return, they promise to pay you back later. With interest. That's it. That's a bond. Let's make it even simpler with an example. Imagine you lend 1,000 euros to a government. They say, "Thank you. We'll pay you 5% interest every year, and after 10 years, we'll return your 1,000 euros. So what happens? Every year, you receive 50 euros, and after 10 years, you get your 1,000 euros back. That 1,000 euros is the principal, the 5% is the interest rate, and the 10 years is the maturity. Now you might be thinking, why would anyone buy bonds? There are three main reasons. First, steady income. Second, lower risk. Third, capital preservation. But bonds are not completely risk-free. Now here's where things get really interesting. Bond prices don't stay the same. They move constantly. And the biggest factor that moves bond prices is interest rates. When interest rates go up, bond prices go down. And when interest rates go down, bond prices go up. This relationship is extremely important because it connects bonds to the entire economy. And this is exactly where central banks come in. Central banks use bonds as a tool to control the economy. Sometimes, when the economy slows down, interest rates are already near zero, and normal tools stop working. Central banks step in and start buying bonds. This is called quantitative easing. Central banks use quantitative easing when the economy slows down, interest rates are already near zero, and normal tools are no longer enough to stimulate growth. If you're not familiar with quantitative easing, I've explained it in detail in another video on this channel. You can find it in the link below. But here's the key idea you need to understand. When central banks buy bonds, bond prices go up, and interest rates go down. Lower interest rates make borrowing cheaper, which encourages spending and investment. So bonds are not just investments. They are also a powerful tool used to manage the entire economy. And one more important thing, bonds are not just something you hold. They can also be traded. You can buy and sell bonds before they mature, and their prices change based on interest rates, inflation, and risk. That's why the bond market is massive. In fact, it's often larger than the stock market. So let's bring everything together. A bond is a loan, where you are the lender. You give money to a government or a company. They pay you interest and return your money later. They provide steady income, lower risk, but also come with important risks. And most importantly, bond prices move in the opposite direction of interest rates. So next time someone says, bonds are boring, you can say, they might be stable, but they are one of the most important parts of the entire financial system.